Good morning, Market Chameleons, and everyone joining us for the first time. Thanks for coming by and checking out the Market Chameleon pre-market show. Before we get started, please take a look at the shared disclaimer. Be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This show, as all our shows, are concerning Market Chameleon tools and products. With that, good morning, Dimitri.
Good morning, Will. How are you?
Good.
Good morning, everyone. I am going to share my screen here. And today, what we'll do is cover how to find potential trade ideas in NVDA stock, with potential option trade ideas in NVIDIA stock. And we'll use this Market Chameleon tool, the trade ideas. And quickly, to get to this tool, if you put the symbol into your search up top, we'll do the NVIDIA. If you press enter, you'll come to the summary page over here. And then on the left-hand side, you'll see a menu. You click on options, trade ideas, and you'll come to this page, which presents you with these option trade idea cards with some information and analytics statistics to get you started. If you're interested in this particular type of option strategy. So let me first close this menu to expand the screen. And the first by default, there are three trade idea cards, and these will be displayed because of their theoretical edge. However, if you want to look for specific strategies that we have available, if you click on the select strategy box, you get a drop-down menu, and you can see that if you're looking for something like bull call spread, you click on this, and then it'll present you with some bull call spread trade ideas with the relevant statistics. Let's come back though to these top three by edge. And here we see filtered out, it came up with three trade ideas: a long call, debit iron condor, and a long put. And all these option trade ideas have a different outlook in these three. Long call is bullish, debit iron condor looking for some movement, long put it's a bearish. So it would, if you have some unique outlook that fits this type of strategy, then this is a trade idea to consider, and we'll go over the statistics, what this means, why it was filtered out. So let's start out with this card, long call. That's simply a strategy. You buy a call. It's a bullish strategy, and you want the stock to increase. And by expiration, if you hold it to expiration, it's got to increase by enough to cover the cost of this option, which in this case is $3.85. So we're looking at the January 17th 140 strike. If you pay $3.85 and you wait till expiration, then the stock has to be above 143.85 for this to be profitable. And currently it's 130.39. So looking at this strategy, and of course it could become profitable prior to that, because it still has premium, a delta, and so forth, but that would be if you're held to expiration. So when we look at this option for $3.85, and we know how many days are left to expiration, we know what the strike is, we know how much the stock has to increase by, and the question would be, okay, if we're gonna try to assess this strategy, what do we think in theory, this strategy is what value or benchmark should I put at it? Is this on the high end? Is this on the low end? Is this at the fair value? When we talk about $3.85, right? So whenever we are in the business of trading financial assets, well, it's just standard practice to have a valuation model, some benchmark to see what that asset in theory is worth, to compare it to the market price. So there are different models we could use. There's no one right model, and you could use different models. It'll give you, it could answer you different questions, and models do require that you put in data, information, assumptions. Sometimes it's assumptions, about things that you expect in the future, like a dividend or interest rates. But in this situation, we're looking at the historical data and saying, well, based on the historical stock behavior in NVIDIA, what is this option worth in theory? Like on average, what is the end value of a similar option, given, provided the distance of the stock price in days to expiration? So if we did that model, we come up with this $7.44. So looking at historical stock behavior, the average price, there were losses. Sometimes it was zero, sometimes it could have been higher, sometimes below, sometimes we took the average of all of them, it's $7.44. And with that, we could see, okay, now we have kind of a base model benchmark to compare it to, and we see that that this market price right now falls pretty far below that average. And if we had to give it a theoretical edge, if we said, okay, this benchmark, if we use that as our theoretical value, what would be the edge, the difference? So here it's a 93.2% edge. So if we're looking at the average, that does give us one piece of data point to compare it to. However, there's a lot of, we have a lot of observations there in history. We're not looking at just one point. This is going back, I think, 40 years of data. And the question is, okay, the average could have gotten skewed up. You could have had a stellar performance there, up 300%, 100%, which really skewed up this average, because obviously that observation, the call could have gone from whatever, $1 to $20, huge percentage gain. And then in that instance, we want to look at a little bit more statistics and ask ourselves, well, how often did the stock, in our observations, how often did NVIDIA stock price behave, in this case, has gone up by a big enough percentage to make this current price profitable, $3.85. In other words, if we looked at $143.85 and NVIDIA is 130, so whatever has to increase by to make this profitable, how often did that happen? So in our observations, that was 35%. So you can see that historically, it's not a high, let's say, win rate, but it's not insignificant. It's about more than a third of the time. Historically, this option would have ended up being profitable. And of course, if you're in that bullish outlook, at the moment, then this could be a potential candidate. So now that we have this data, and maybe this is something we want to explore further, and we'll say, okay, this might be an interesting situation. I know I'm risking $3.85, but from the historical perspective, that could be on the low end of the range, and there's some like a pretty big cushion from the average value. We got a pretty big difference here. Let me go and look at it further. And to do that, we could click on this options chain arrow. And let's see what else we could find about this particular options trade. So when you click on it, so what I did was I clicked on this options chain, right? Go to the options chain, and let's analyze it with more data, more information. Let's see what kind of other insights we could get about it. By clicking on it, it creates this new window, and now you're on NVIDIA options chain. It auto-populates the expiration that we were looking at from the option card. So you can see here January 17th, 25 expiration. And it also automatically selects the call or whatever strategy we're looking at. So in this case, it's the buy January 17th, 140 call for $3.85. So if we looked at the options chain, here the calls are on the left-hand side, puts on the right hand. If we go to the 140 strike, go to the left, here's the bid is 375, the offer is 385. So it selected the offer because these are the displayed bids and offers. And if we're looking at it from the long side, we're going to analyze the ask. This is the available price. We could get an immediate execution. So let's analyze that price. However, as a trader, always keep in mind we're trying to get better executions because we want to save on that. We want to capitalize on better executions if we can. In other words, you could try to get a fill at 380 or 381, 382. But let's analyze this from the perspective of $3.85. So I'm not going to add anything to this strategy. You could always just add what if I sold the call, and then that will populate in there. So like, for example, if I say, well, let me take the 145 call and sell it. So I click on the bid, and you'll see that a sell 180, 145 call at 260 pops up. But I'm going to remove this for now because we're not analyzing the call spread. We're just analyzing this call on its own, independent. And we're going to run the analysis and see what else we could find. So run analysis. Let me close this menu to expand our screen. And when we do that, we get now more details and information regarding this call option. So here we're going to analyze that price, $3.85. And now we have two models to give us even more information about the price of this option. Okay, so the first model was that historical stock return distribution, like we were talking about. This is looking at the historical stock behavior and creating this theoretical value, which is at $7.44. So you could see the difference is $3.59, the difference between our market price and our theoretical value. The historical win rate we just discussed, that's the amount of observations that we have in our historical analysis that would have resulted in this being profitable. That's 35%. I mean, 35% of our observations, the NVIDIA did what it needs to do to make this option profitable. Now that's, keep in mind, that was based on for that entire period to expiration, right? So that would be if we held it, let's see, over here, we see this is 21 trading days, 31 calendar days. So if we went through all 21 trading days from start to finish, this would have ended up being 35% of the time profit. However, in the 21 days, we know that the stock moves around and it could move up a lot, then come back down a lot, come back up. So it still trades and it has volatility. And that could mean that there are times that this option was in the money, covering the entire cost and prior to expiration, and then maybe by expiration it wasn't. So at any point in time in those 21 trading days, did the stock behavior, how often did the stock behavior actually increase by enough to make this option in the money enough to be profitable? So this isn't even considering what the time premium. It's just saying if we just used parity, right? If we just said that this option at parity, that means the difference between where the stock is and the strike price, no time premium. At any time, how often did the stock behave enough to cover the cost of this and still make it profitable? So that happened 48% of the time. Okay, so it's a little bit higher. We're almost at this point. What this is saying is that the historical probability of this being profitable, just even at parity, was 40, almost 50-50. No, not quite, but 48% of the time, which seems now a little bit better, if we looked at it from that perspective. Okay, so let's move on. Let's keep analyzing it from another, angle. Looking at that, what is the price of this option usually in these circumstances? So if we said, let's take out the stock behavior for now, and option markets are priced how they're priced with the implied volatility. And let's say analyze that. Let's just analyze at, with X amount of days to go and the stock price a certain distance away from these strike prices. Look at the historical database, do all that work for me, and tell me if I took the implied volatilities of a similar option, right? This is obviously an upside call here, 7.4% away from the spot price. So looking at that, go fetch me what the implied volatility is for this option. And it's not always going to be the same. Sometimes it's higher, sometimes it's lower. But use that, plug it into the Black-Scholes model, and tell me what the option pricing model would value this option on average. And that's $3.34. Okay, so that's using the implied volatility. That's using the option pricing model and its implied volatility. So that's a little bit different because here we see that now we have a situation where, in theory, the way the stock behaved, it was, looks like, it's priced below that. But if we looked at the option pricing model and the implied volatilities, then, we're priced above that, above the average. That's a 51% theoretical edge we're paying up, where it typically is priced. So that's the average. What about the median? Because the average could have gotten pulled up too. So the median, where half the observations were above, half of the observations were below, were similar to the average, 3.34. So here we are paying about 51 cents higher in this model, right? So we're running two different models to get two different answers. not right more than the other. It's just two different models writing two different answers. You know, just kind of like if you're valuing a piece of real estate, well, I could run a model and say, give me the average selling price of the last, year, of a similar piece of real estate, and you get this value. But then I could plug in another model and say, well, tell me what it would cost me to buy a piece of land and build a similar house, and then I get a different answer, or tell me what would I value this if I use the rent and give it a cap rate of 10%. So obviously, using a different model with different data and assumptions, you're going to get different answers, but you have those tools to help you gauge the market prices. Okay, how far away are they from those benchmarks? So now looking at this, we also have the average, we have the median. Well, what about the high-low range? What was it on the lowest and what was it on the highest end? So if we use the lowest implied volatility that we captured for similar option, then and plugged it into this situation, then the price would be $1.73. If we use the highest implied volatility in our historical observations for similar option, plugged it into the Black-Scholes model, then this option would be worth 626 right now. So that's the historical high-low range. So you could see, or somewhere like maybe a little bit higher than the middle. So now we get these information. They're like, okay, from stock behavior, it looks below the average. For the implied volatility, it's above the average. So the market's really pricing it in between the two, right? Kind of like not exactly in between, but above one, below the other. So that's how the markets are pricing this particular option, and that's how we keep in mind. That's what it's doing. Going a little bit further, we could look at the current market and see what is the midpoint relative to the bid and offer. And this just gives us an idea of the liquidity or the state of the market at this time, right? So the bid is 375, the offer is 385. That's 10 cents wide, meaning that if we reference the market prices, that the fair value is somewhere between 375 and 385, because these are firm bid. This is a firm bid. This is a firm offer. People in the marketplace are when you bid and you put an offer, you're held to unless you cancel it before execution. And if we wanted to just give a 1 point of fair value instead of a range, we could, industry standard, just take the midpoint of the bid and offer. That's $3.80 in this situation. So it's a relatively narrow market. It's not very wide, but there's some room to potentially negotiate a better execution than $3.85. Even you have a whole 10 cents between the bid and offer. So putting in a bid at 380, maybe 381, 379, whatever it is, maybe you could get better execution. And of course, that is important, because what you're doing is reducing your costs, you're reducing your risk, because the less you pay, the less you risk, right, for a call. And you're increasing your potential return. So the less you pay and it goes up, well, you just made more, right? Because you paid less, you made more. So always keep in mind, execution is important. I had, there are customers, which is interesting. I'll tell you this. There are customers who would say, well, I did 100 trades and I completely broke even after 100 trades, right? So I did 100 trades and it's a point for 50-50. and then they gave up. Well, when I wrote algorithms to trade, I was always looking for those scenarios because you don't even realize how close you are to a profitable strategy. Because if you could get a coin flip after 100, that means you only need to tweak it a little bit more to reach profitability. That's it. Maybe what you were missing is the execution, or maybe you had scenarios in there you should have stayed away from. You do a little bit more analysis and you're right above that 50-50. So once you get, if you're at 50-50 and you gave up, you probably gave up already at a successful, you have like this already almost successful model, right? Once you get to that 50-50, especially if you're covering the cost of your commissions and you're at 50-50, you're right there. You have a little bit of tweaking to do. That's where you do the research and say, where can I improve? Was it in my execution? If I could improve my execution, cost a little bit. Was it like where I had to stay away from because my losses were coming around this strategy doesn't work around certain periods, like maybe earnings or certain events, or I keep getting keep getting plugged on these situations. Or was it maybe that I have to introduce a little bit of hedging going on, where if I hedged off mitigated some of this extra risk that I had, and took that away, boom, that's you got a profitable strategy. And I can't tell you how many people get to that point and that's when they give up, where they don't just do that little bit extra step to get over that 50-50 mark. I need to improve something here in my strategy, my algorithm, my trading, system. My trading system needs a little bit more tweaking and improvement. So keep that in mind. Here we got the risk sensitivity, which is just telling us the delta, gamma, vega, theta, rho of the option. So these are things that we're looking at the option and managing those risks, like I talked about. Managing those risks could be the difference between, going over that, from a loss to profitability, from break even to profitability. And well, I'm going to stop right there because we're right up at 9:30, but we'll continue.
Perfect, D. We did get in a little conversation about Philadelphian schools. What years were you at Penn State?
At Penn State?
Yeah.
91 to 95.
All right. So you missed Steffens on, and he said he's a graduate of Penn State 86. So that was not way before your time.
Yeah.
It was before your time. Wasn't there a professor when you were at Penn State who had been an options trader on the Philex? I kind of remember that. And then
yeah, my professor was who taught me options. Was a options trader on the Philex. I think worked for Susquehanna at one point. Then became a professor and taught option classes at Penn State. But yeah, I believe he worked for Susquehanna in the very early years.
Yeah, that's awesome. I know you and Dana have both mentioned that. I'm gonna have to ask my daughter if he's still there, or look at a syllabus or something. But anyways, great job, D, as always. It's an interesting look at NVIDIA and the way to manage your trades, and keep an eye on things using Market Chameleon. Great job as always, my friend. Everyone, thanks for joining. Remember, thumbs up, give us some likes, follow us. If you're new to Market Chameleon, we do one of these shows every day, walking you through different tools and things we offer on Market Chameleon. Great job as always, Steve. Thanks so much, buddy.